You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast. This week, global markets are facing, a really potent mix of policy clarity on one hand.
And just extreme data uncertainty on the other. It's a real collision.
Exactly. We're watching central banks moving in dramatically different directions while, inflation remains this dominant global force.
Right. And the interplay between last week's signals from, say, the Bank of Japan and the Bank of Canada, it's setting expectations for the rest of the year across all the G10 economies.
So we're going to unpack that divergence.
Yeah.
We'll look at why the Bank of Canada agreed on the need for a cut, while the Bank of Japan is saying conditions for normalization are almost met.
And we'll also break down the critical insights we expect from the upcoming minutes from the Federal Open Market Committee and the Reserve Bank of Australia, and analyze why earnings from a major tech firm will influence broader market sentiment for you.
Here's what you need to know. So let's start with that divergence, because it really tells this fantastic story about inflation being a global issue, but policy being intensely local. We have the Bank of Japan signaling they're ready to pivot toward tightening, which is, that's a monumental shift.
And what's fascinating here is the almost surgical communication coming out of Tokyo. The Bank of Japan's summary of opinions. It strongly suggests they're gearing up for a rate hike.
How so?
They're noting that the conditions for taking a further step toward policy normalization have, and this is a quote, almost been met.
Almost been met. That sounds like a green light, but with a finger still kind of hovering over the switch. What's the critical filter they're waiting on?
It's all about the sustainability of those wage increases. One member noted that while the economic forecasts are materializing, they really need to ensure that momentum is sustainable before they make the move.
So they're raising market expectations, but not committing.
Exactly. They're saying there's no need to rush, but they must raise rates without losing the appropriate timing.
It's an exercise in patience and precision, then. They're trying to thread a very fine needle.
Precisely. Now, if you just flip that picture completely, you land in Canada, where the entire conversation is about easing.
Right.
The Bank of Canada minutes revealed their governing council agreed that a cut to the policy rate would be needed, signaling a completely different phase of the cycle.
Okay, so this is a crucial distinction. The Bank of Japan is moving into economic strength, while the Bank of Canada is signaling a move out of restrictive territory.
Absolutely. The arguments for cutting in Canada were all about continued excess supply, persistent weakness in the labor market, and, expectations for pretty tepid growth.
But they must be in restrictive territory to even contemplate a cut, right? Let's just clarify that point about their neutral rate, because it's easy to get confused.
That's a vital point.
Yeah.
The Bank of Canada estimates the neutral rate, so the rate that neither speeds up nor slows down the economy, is somewhere between 2.25 and 3.25%.
And their current policy rate is what?
Around 5%. So it's significantly higher, meaning policy is highly restrictive. Members agreed that while a cut is necessary, they had a range of views on the timing.
So policy is actively slowing the economy. The question is just when they stop applying the brakes, not if they should.
That's it.
What were the main arguments for delaying the cut then?
The delay was just rooted in caution. They want more information on the persistence of inflation, the extent of labor market weakness. The signal is, we need a cut, but we're waiting for the data to align.
Okay, so with that split defining the global policy landscape, let's pivot to the data that's going to challenge both of those camps.
Right.
Wednesday is huge. We get the minutes from the Federal Open Market Committee. We know the Federal Reserve reduced rates, but the minutes should reveal the division underneath.
We really need to see the depth of that internal split. The last cut, it brought the range down to 3.75 to 4%. It had two dissenters.
One hawkish, one dovish.
Exactly. Which tells you the committee is deeply fractured on the path forward.
But the real insight we're looking for isn't just about the cut itself. It's about their long-term view, isn't it?
That's the key takeaway. We need to look for clues about their discussion on R-star, the long-term neutral rate. If members believe R-star is permanently higher, it means that even if they cut a few more times, policy will stay restrictive for longer than markets currently assume.
And complicating the picture for the Federal Reserve is this massive information gap. We have to address the data uncertainty surrounding the U.S. economy right now.
This is the elephant in the room. Due to that 6-week government shutdown, officials have cautioned that the October employment and inflation figures are likely lost.
Lost, as in we might never get them.
We might never get a clear picture for that month. It creates a huge challenge for policymakers who rely on, a full and timely data set to make decisions.
Which means those minutes will be read with even greater scrutiny. The data they had in that meeting might be the last reliable data they see for a while.
Correct. It makes their forward guidance exceptionally important.
Now, let's pivot to the Pacific. Tuesday brings the minutes from the Reserve Bank of Australia. They kept their cash rate unchanged at 3.60%. What are we listening for there?
We're looking for details that justify their patient approach, especially after Governor Bullock made it clear that while they are proceeding meeting by meeting, it's possible fewer cuts might be needed in this cycle.
Which suggests a hawkish bias, even though they're holding steady.
It does. And here's where that patient approach collides with economic reality. Their inflation forecasts. They raised them sharply.
Okay, let's talk about that.
We need to focus on what they call trimmed mean inflation. For those unfamiliar, that's a core inflation measure that removes the biggest price swings to get a clearer view of underlying momentum.
And they raised the forecast for that.
Sharply. For June 2026, they raised it from 2.6% to 3.2%. This shows the board is acutely aware that inflation is proving far stickier and more persistent than they had hoped.
Moving across the globe, Wednesday also has the United Kingdom Consumer Price Index, and this is a decisive piece of data given the deep policy divide at the Bank of England.
The divide is almost theatrical. It was so strong in November that Governor Bailey had to cast the tie-breaking vote to keep rates at 4%.
So the upcoming inflation numbers are critical for their December decision.
Absolutely decisive. And the expectation is for a drop in the headline number.
Why are we expecting that drop, and does it actually mean the inflation problem is solved?
Well, we're expecting headline year-over-year inflation to slip to 3.6% in October. But crucially, this drop is mainly driven by what economists call base effects.
Meaning you're comparing to a very high number from last year.
Exactly. It's mostly related to energy adjustments from last year. So it's more of a mathematical drop, not necessarily a sign of broad, immediate success in crushing underlying price growth.
So the headline looks good, but the underlying fight remains fierce. That speaks directly to that internal split.
It does.
Now, let's talk about Canada's Consumer Price Index, which lands on Monday. The Bank of Canada has already signaled they need to cut, so this is at a critical juncture.
It absolutely is. And since they explicitly said a large surprise would be necessary to resume cutting immediately, they've sort of prescripted their behavior.
They're not looking for a reason to cut, then.
Not yet. Their internal report already anticipates inflation will drop in October due to lower energy prices. So unless this number is a massive deviation, they'll maintain their wait-and-see stance. They're playing the long game.
We also have key inflation readings from Japan on Thursday. Their National Core Consumer Price Index is expected to accelerate a bit.
Yes, to 3.0%. And that expected acceleration, it's broad-based, and it plays right back into that Bank of Japan dynamic we discussed. It validates Governor Ueda's view that underlying inflation is gradually accelerating.
But this is where it gets truly fascinating, because the data might support the hike.
But the politics may not. Precisely. The political complication is real and a potential source of volatility for you, the investor. Finance Minister Katayama maintains that inflation has yet to stably meet their goal.
So he's signaling no urgency.
Limited urgency, yes. And Prime Minister Takaichi's planned fiscal stimulus could actively complicate the Bank of Japan's delicate path toward normalization. So the bank has to navigate both the economic reality and the political headwinds.
Shifting to China, Thursday also has the People's Bank of China loan prime rate announcement.
And analysts suggest they'll maintain the benchmark rates for the sixth consecutive month. The central bank seems to prefer targeted open market operations for liquidity rather than broad rate adjustments.
So they're using a scalpel, not a sledgehammer.
You could say that. Recent activity data was mixed, house prices are contracting, and it suggests they may be conserving their ammunition for next year rather than making a big move now.
Finally, we have to look at high-frequency activity data. Friday brings a flood of flash purchasing managers' indices from the Euro area, the UK, and the US.
And the Euro area PMIs offer an interesting contradiction. They've been painting a pretty positive picture of the economy in the early fourth quarter.
That sounds good, but what's the caution here? Why can't we trust the upbeat survey data entirely?
Because that upbeat survey data, it contrasts sharply with the soft hard data. We're still seeing subdued industrial production and soft retail sales numbers. This suggests a continued fragility just beneath the surface.
So structural weakness is still a major concern.
It is. Analysts are warning that global headwinds, like potential shocks from China, still outweigh those cyclical improvements suggested by the optimistic surveys.
And we have to talk about the corporate catalyst this week. Wednesday features the highly anticipated earnings from Nvidia. Why does this single company matter so much for the entire macro market?
It's the sheer centrality of Nvidia in the artificial intelligence market. I mean, they're the shovels in the gold rush. Their performance is seen as the proxy for the entire AI rally and for future tech investment globally.
So if Nvidia stumbles,
Then the appetite for high-growth tech names, and therefore overall market sentiment, takes a massive hit, and expectations are just astronomically high.
right, we've seen analysts raising price targets, citing over $500 billion in secured orders for their next generation chips.
It represents massive confidence in the AI transformation, yes. But, we have to explore the duality here. Not everyone is convinced these valuations are justified.
We've seen some big names betting against it.
Yeah, exactly. Notable contrarian investors, like Michael Burry, positioning against the rally, and SoftBank sold its entire stake.
So investors are watching the actual results, the revenue, the profit, to see if they can justify both the lofty valuations and that huge order of backlog. It's the ultimate reality check for the AI story.
It is. If the numbers disappoint, you'll see a rapid decompression of those valuations across the tech sector. If they blow expectations away, it reinforces the narrative that this growth is structural and long-term.
It really is a massive week of tension, divergence in policy, uncertainty in data, and this huge corporate catalyst.
And if we look at the confluence of all these events, the most provocative thought for you to carry into this week is this. With a loss of reliable U.S. data, central banks globally are navigating in the dark. They're forced to rely more heavily on ambiguous forecasts and, frankly, political signals.
So the lesson for you as a market observer is that in the absence of solid data, narrative, and sentiment, whether it's political pressure on the Bank of Japan or the earnings story of one crucial tech giant, will carry outsized weight in driving global markets.
That's a comprehensive look at the central bank dynamics and data catalysts shaping the macro picture this week.
Appreciate you tuning in for the analysis. Join us again soon on the Financial Source podcast for more essential insights.